Session and panel is Corporations and Capital Markets in Emerging Economies. And in order to moderate this session, I wish to invite Madam Chitra Ramkrishna, Managing Director and CEO of the National Stock Exchange of India. Plus, I would like to invite our distinguished panelists, Mr. Vedat Akkirai, President of the Center for Corporate Governance to Boğaziçi University, Mr. Mulyaman Darmansia Haddad, Chairman of the Indonesia Financial Services Authority, Mr. Vladimir Gusakov, Managing Director of Government Relations of the Moscow Exchange, Mr. Ozhan Özbaş, Associate Professor of Finance of Koç University, Mr. Ethiopis Tafara, Vice President for Corporate Sustainability and Risk and General Counsel of the IFC.
Good afternoon, and it is indeed an honor and pleasure to have this opportunity to chair this session, which is the last session for the day. And therefore, I think we will try to achieve multiple objectives being the last session. What I understand is that there is definitely a constraint on time, so we are going to be brief and crisp in our deliberations. I also understand that there are a lot of questions that floor participants would like to ask, and we'll certainly try to leave time for the floor to raise questions so that we close on an interactive note today. What we will really do is me and the co-panelists will make a few introductory remarks followed by a round of questions, and subsequently if there are questions from the audience, we would be happy to take it from there. The session is really about corporations, their ability to access markets for their financing needs. If we look at it, essentially in emerging markets today, while emerging markets contribute to a significant proportion of total GDP, their proportion of market capitalization is really much, much smaller. The second trend that we all notice, therefore, when we look at emerging market statistics is that the level of debt equity is high. So I think in today's panel, some of the things that we will try to cover is the specific financing needs that corporations and enterprises have and their ability to be able to raise this easily from the market. If I have to just set the context for the panelists to then make their remarks, for any stable markets in emerging market economies, I see that there are 4 pillars that are essentials for a stable market development. The first and foremost, all of you will agree with me, is really about macroeconomic stability of the market under consideration. The second is about sound banking systems. And in the current context of a predominance of bank lending in many of our economies, and coupled with the fact that Basel III imposes a new set of requirements on the levels that banks can participate, as well as banks' ability to meet long-term sustainable capital needs for infra projects or for growth companies, is a big question in terms of the role that sound banking systems can play in the development of markets in emerging economies. The third pillar that experience shows as critical is about the level of institutional investor participation, the maturity of institutional investor participation, the broad breadth of institutional investors that participate. The fourth pillar is around adequate regulation and supervision. Adequate regulation and supervision, one, as something that provides the basic confidence and systemic comfort in the market, but secondly, also around adequate regulation and supervision to nudge the right kind of policy direction, as in nudging to move away, for example, from only loan-based financing setups, or to move from only large corporation funding to growth company funding. So what kind of regulatory nudges and supervision is required to facilitate that kind of a market development? But all these four pillars face one important constraint, and that is around the resilience of these capital markets. And one lesson we have all seen in the last few years is around the external shocks. How external shocks can have an impact on the resilience of a market, even if these four pillars internal to an economy are working well. And the case in point is really the OECD paper of 2011, which shows how in Israel, for example, even after a well-developed corporate bond market, because of the external shocks, we saw several months of drying up of corporate bond activity, which required, again, government interventions and policy nudges to bring back that liquidity. So all that I want to put in context here for our discussions today is that there are clearly key pillars which are important for us to drive market development in emerging economies. And some of our discussions today from my co-panelists will add the breadth and color to whether these need to be seen in any different way, whether there are experiences that they have seen in their respective domains which have helped deepen these markets, which have helped bring down costs for access and have widened the options for corporations to raise money from the markets. With these opening remarks, I will also request each of my co-panelists to make a short introduction of themselves before the introductory remarks. May I start with you, Mr. Ozbash?
Sure. Well, thank you to the organizers for putting together this wonderful event. My name is Oğuzhan Özbaş. I'm an associate professor of finance at Koç University. I work on corporate finance topics and corporate governance topics, finance being an important leg of governance. Beyond that introduction, should I go into my remarks? So I thought I would start with an academic view on financing and how it relates to corporate governance. So it's basically trying to address the problem of bringing together entrepreneurs with ideas but no funds, with investors who have funds but no ideas. So how do we get these two people or two sets of people together? Through financial contracts. And financial contracts, for a moment, imagine we have a blank slate. We didn't have debt financing. We didn't have equity financing. What kind of a financial contract would you write? Well, it depends on the problem you're trying to solve. So scholars have thought about what are the main frictions that we're trying to solve with these financial contracts. Well, to the extent the problem is diversion of cash flows by the entrepreneur away from the financier, to the extent the problem is asymmetric information, to the extent the entrepreneur knows more than the financier, to the extent contracts are incomplete, you cannot write what will be done under every circumstance. There will be times when neither the entrepreneur nor the financier will have clear rights, while in those unspecified situations who have control rights to make decisions. If that's what financial contracts are trying to solve, well then the answer is, it turns out, the best contract, starting from a blank slate, the best contract that deals with those problems is debt financing. It's not equity financing, it's debt financing that leaves the upside to the entrepreneur and only brings in the financier in bad states of the world when there isn't enough, gives the financier the control rights to come in and collect what's remaining. That kind of contract is more or less a debt financing contract, and that, in my mind, explains why emerging markets, compared to developed markets, rely more on debt financing and less equity financing. Right, the problem, perhaps these fundamental frictions are stronger in emerging markets, and that's why debt financing is the preferred financial contract to deal with those heavy, pronounced frictions. But as Ms. Ramkrishna mentioned, that leads to a fragile financing structure, more debt financing, less equity financing. It's not resilient, it's not stable, especially in the aggregate, to external shocks. So that's where regulators have, lawmakers and regulators have a role. They need laws and regulations that address those fundamental frictions, whether it's in the commercial code, whether it's in the capital markets law, whether it's in corporate governance regulation. It is to prevent the preference towards debt financing that solves those frictions, while instead of financial contracts trying to solve those frictions, it's the role of laws and regulations. So in that sense, Turkey has have had a number of laws and regulations and interventions in the last 3 years or so. Maybe I'll mention more of them in the second round. But the most recent corporate governance regulation, in my mind, is especially targeted towards making equity financing, the equity financing contract more efficient than before. Because the basic corporate governance problem in developing economies like Turkey is that the controlling shareholders could be doing things at the expense of non-controlling shareholders. So by introducing independent directors, I know they bring a whole wealth of expertise and independent thought, but what the new regulations in Turkey they're doing, they're giving independent directors significant responsibility to overview related party transactions. For instance, if all related party transactions in excess of 5% materiality threshold, they need to be appraised by a licensed institution and then accepted by only the independent, voted among independent directors. To the extent the decision is not unanimous, it has to be disclosed to the public disclosure platform. To the extent it's not approved, yet the rest of the board wants to proceed with the related party transaction, then the issue comes to a General Assembly where only the non-related parties can vote. So these sorts of regulations are trying to nudge the investors towards equity and away from debt financing. So that's how I view it, as more of a developmental tool.
Very interesting. Mr. Akre, can I ask you to, of course, introduce yourself, and you're free to comment on some of the points Mr. Özbaş has already made, since the markets that you're talking about are the same markets.
Okay. I'm a professor of finance at this excellent university. The name is up there. And also, I'm working with a great team of people at the Center for Corporate Governance. And also is a member of our advisory board. There are many other members here. I think in this panel we have a problem, because the previous panels, especially just the one just before this, the things talked about in there, and your remarks at the introduction, and Oğuzhan's picture of the whole story says it all, basically. And I should first start by saying that everything in the previous panel, the talks, and all of them I could sign underneath. But the practical advice that David is around here offered, and what they are doing in Shenzhen are basically all what should be done, since our topic is emerging markets. We have another problem. This gentleman here is an engineer by origin, PhD from MIT, and he's talking about corporate governance. It means either corporate governance is important or we are coming to the end of the world, something is missing here.
Or hopefully before.
It's all pervasive.
Let me, if you permit me, let me make a few, since we're talking about emerging markets, just some things I see in the overall picture. First of all, the capital markets in emerging markets in general are not as developed as they should be. So this poses a big problem for SMEs accessing market-based financing. So they have to fall back on bank credit.
So much.
And bank credit for a small company is basically a contract for death at a young age. But we don't have a record of companies that went away because of bank credit. We only know about the ones which are alive, basically. I'm reading a book called Debt by an author, Margaret Atwood, I think. She's a philosopher, a writer. She started about debt, and I learned that in original Latin, the term for debt and sin are the same word. So when they say, "Oh Lord, forgive our sins," it means, "Oh Lord, forgive our debt," means the same thing. But that problem of access to market-based financing is particularly a bigger problem in emerging markets, small companies. Because growth at the end of the day requires smaller companies being successful and then eventually becoming big companies. That's the only way. I mean, you can't do it with economic policy or by regulation or by rules and by laws. That's a no game. That's one thing. So this represents a risk in growth in emerging markets. It's a risk for developed markets as well. So it goes hand in hand. That's one observation. And we are in a world of debt. Currently, globally, the amount of debt outstanding, including public debt, private bonds, and loans of all types, is about 4 times of equity outstanding. And this has been so since late 1990s. It has peaked in 2007, and it's not coming down. It's actually going up. Too much debt, if Professors Modigliani and Miller were alive, if they were here, I'm sure they would change their presentations, and they would say, well, we said capital structure does not matter, but it matters in this world. I mean, we have too much debt. So basically, what is needed is room for more and more equity financing for smaller companies in emerging markets, also in developed markets, for similar but sometimes different reasons. Okay. Now, since our topic today is corporate governance, and OECD is about to finalize the revisions, hopefully, within this year, it is clear that also shareholders, equity holders, stockholders, are better gatekeepers, by definition, by nature, than bondholders, because bondholders have only a transient interest in the company. They'll be out in 2 years, 3 years, or 5 years. But shareholders they are the owners. So it makes very much sense. Think of maturity. And that's the picture. So promotion of more market-based financing and more equity financing would be my recommendation for emerging markets to solve the current problems and hopefully to prevent worse crisis in the near future. I'm afraid. Okay. Now, corporate governance as being defined more and more smartly and wisely in recent years, and thanks to OECD and IFC institutions like that working on it, and the interest in this room. It's late afternoon, corporate governance, a boring topic, and people are still around. That's interesting. I haven't seen it before. Maybe it's because of my university, I don't know. Yes. Now, but we have, I think, the wise principles of by OECD are perfect. They are up to date. They address many current problems and issues, and cover up many missing points from the past. But the thing is that we have to realize that you cannot regulate corporate governance. That's an impossibility. We'll make rules, principles, mandatory or compulsory, explain, whatever. But by just going with those rules does not make you a good corporate governor. Let me give you an example to make the case here. independent directors, board members. Okay. I mean, all regulators in all jurisdictions have definitions of independence. I mean, you have to say, if a person satisfies these criteria, then you are independent, you're okay. And that's the only way we can do. But you may have as many independent members as you want, but who guarantees they will act independently? And the purpose is not to have independent members, for members to act independently in the best interest of the company and the whole ecosystem around that. So we cannot do that. This applies to board structure, board committees, even to related party transactions. I mean, you cannot define it and tell companies you do this. If you don't do it, it's bad. If you do it, it's good. But then there are many ways of doing it in full compliance with the regulation. We have to realize that. Do we need regulation? Sure we do. It's at worst a guidance, a light which will show us how we should think and go. But that does not take us to our final destination. I mean, who will ascertain that this will get the things? One final point I want to make, with your permission. I mean, everywhere from now on, when I get an opportunity, I will talk about short-termism versus long-termism. Short-termism is a disease of our times. Short-term results. Get me short-term results. Why? Because everybody wants to see the short-term results. Okay? That's a pressure on all of us. Okay? But as they say, short-term gain often becomes long-term pain, I mean, at the end of the day. Now, economically, mathematically, all of us can prove that short-termism is irrational and it's a bad way of making money. And irrevocable also. I mean, just a simple calculation in Borsa Istanbul, in the Turkish stock market. During the last 25 years, from 1990 to today, there are many 1 years in which you lose money, fewer 2 years in which you lose money, fewer 3 years, fewer 4 years. You cannot find any 5-year period in which the rate of return on the Istanbul Stock Exchange, an index, a broad-based index, will be worse than the best interest rate available. And on the average, the annual rate of return across all these 200 plus 5 years is like 17% per year, which no debt instrument can beat. We'll set aside that, I don't know about. But then saying this, oh, okay, this guy said long-term is profitable, let's be a long-termist, it doesn't work. So economists cannot make people long-termists. I mean, our proofs, empirical findings, teachings will not do that, okay? Numbers are here, okay? People are short-termists. In Istanbul, the average holding period for a local investor is about a month. For a foreign investor, it's about a year. In the US, it was 6, 7, 8 years, 20 years ago, and it's down to a couple of years, and going down, average holding period in stock investment. So it's here. So what do? We cannot regulate how people will behave. There's a problem of short-termism. So what can policymakers and regulators do? Okay. I think we have to also had implied these things actually. We have designed our policies and regulations which will result in a market mechanism which will reward good corporate governance and long-term thinking. A mechanism in which traders, investors, companies, all of us consumers can trade freely. Okay. Otherwise, we cannot do it. That's for sure. And in this, to wrap up, institutional investors, pension funds, mutual funds, sovereign wealth funds, whatever, those systems and the way we regulate them, I think, should be revised. Because for example, a good pension fund system is a cure for unnecessary volatility in market values. Our market values jump up and down when fundamental values are not changing. That should not be, at least to that extent. That's unnecessary, unneeded volatility. And strangely enough, systemic risk was a popular term until this year or last year. We're not talking about that much. Much of systemic risk is because of short-termism, actually. Okay. So large institutional investors with a long-term orientation will smooth out the market, and it will be a favor for equity financing. And also, as John mentioned in the previous panel, as long as we have this tax code favoring debt financing against equity financing, it's no competition. I mean,
sure.
Interest payments are tax deductible, dividends are not. So
sure.
That's
Thank you.
what I would like to say.
Mr. Gusukov.
Thank you very much. You see, it's a great pleasure and great honor for me to be on this stage today. And I'm very grateful to the organizers for that, and I'm very grateful to the hosts. Thank you very much indeed. Yeah. Now, you see, I was an associate professor of mathematics in my previous life, in the previous millennium. Yeah. Nowadays, I am managing director of government relations of the Moscow Exchange since, I believe, October the year 2013, and simultaneously I am for about 5 years a chairman of advisory council under the Financial Market Committee of the State Duma, which is lower chamber of Russian parliament. And just before that, in the year 2009, 2013, as a managing director for corporate development of Moscow Exchange, I led the corporate reform of the group, and after the reform was successfully fulfilled, now I'm occupied this new post. Between the years 2004 and 2007, I was deputy head of a Russian regulator, which is Federal Financial Market Service. You see, after leaving the university, I worked with a number of government authorities, public authorities, such as the Russian Federal Property Fund, Ministry of Finance, Agency for Restructuring Credit Institutions, which is now Russian State Agency for Depository Insurance, Deposit Insurance Agency, and State Invest Corporation. And I was a deputy CEO of a couple of big Russian banks possessed by Lukoil and Gazprom. Since the year 2008, I am at a number of boards of I'm in the boards of and the chairman of audit committees of a number of state-owned enterprises such as Russian Railways, Agency for Housing Mortgage Lending, and Rosagra Leasing. And to finish with, in the year 2012, I was recognized as the best independent director of the year, and simultaneously as the best corporate governance director in the Moscow Exchange Group. And to finally finish, last year I was recognized as the best chairman of the audit committee. With regard to the corporate governance issue, I will start with just a couple of words of necessary words about the Moscow Exchange Group itself, and what is for small and medium enterprises at our exchange, since, frankly speaking, not only the major, but I could say the only exchange in Russia, which provides exhaustive access to Russian financial markets. It is the main liquidity and price discovery center for Russian instruments, hosting trading in equities, bonds, derivatives, currencies, money market instruments, and commodities. Our group also includes Russian Central Securities Depository and the National Clearing Center, which performs the function of central counterparty. Moscow Exchange ranks the world's 22nd exchange by total capitalization of shares traded, But we are the second largest exchange platform for bonds trading and the fifth for derivatives. 2 years ago, we became public. I mean, that very finish of the corporate reform. And we are the 14th public exchange by market capitalization in the world. Our capitalization is about $3 billion. We have about 250 listed issuers of ordinary shares. Capitalization of 15 top issuers makes 72% of the total market capitalization. And their share in secondary trading volumes in previous year was 89%. Capitalization of really small and medium enterprises is rather tiny. For them, it is much easier to raise funding at our exchange issuing bonds, which is a real alternative to banking credits in Russia. And as I have already mentioned, our organized bond market is the second in the world. And a few years ago, we have created a new exchange sector called Innovation and Investment Market, dedicated to innovative and high-tech enterprises with high growth potential. The issuers gain some benefits from this IIM listing. For example, partial compensation of market entrance expenses, 3/3 of all expenses, but not more than 5 million rubles, which is about 100,000 US dollars today. And zero capital gain income tax is presumed for long-term, more than 5 years, investors to the shares of the companies in the sector. Now, 25 equities are listed at Moscow Exchange Innovation and Investment Market with total capitalization of 2.5 billion US dollars. You see, we really hope that this new exchange segment will help innovative companies in raising capital and simultaneously will help special state corporations responsible for development of innovative sector of Russian economy, such as Rusnana and Russian Venture Corporation, to help them to realize their exit strategy. You see, the fact is that we have a steering committee or coordinating council of this IIM, of this innovation and investment market of Moscow Exchange, headed by former Russian Vice Prime Minister Mr. Anatoly Chubais, who is now CEO of Rusnana. And you see, the fact is that the exchange is the final goal to these companies. Final point is the chain of this business angels, venture investors, and so on. In some countries, this industry is quite well developed. Quite few companies, quite few countries. But you see, in Russia, it was very new, totally. And you see, Moscow Exchange is the very place where we gather both investors and potential startups and so on. You see, they start being traded at the Moscow exchange, say in sometimes 2-3 years period of time, but they can start not being traded at the exchange, but we have special IPO boards, which is not exchange sector, but still. It's very new and small yet, but we hope it somehow will help.
Interesting. That's an interesting thought. Mr. Akare?
It's owned by us.
What we will certainly do is that after the first round of the initial remarks, then we can focus on a few. Mr. Haddad, can I please request you for your brief opening remarks?
Thank you, Madam Chair. Let me start by thanking the organizer for inviting me to be part of this panel. historically, emerging market rely on very much on banking. Banking asset dominates the financial assets of a nation in emerging market. It is also the case in Indonesia. I suppose it's also the case in some other emerging market. But then what happened after the crisis, in particular the crisis in 2008, when a lot of banks experienced serious problems, a lot of regulatory initiative which very much constrain bank activities. In this particular time, a bank faced very significant constraint, in particular as far as the capital concern. We know the Basel I, Basel II, Basel III. There's a lot of global initiatives. Some of the emerging market be part of the G20 and other global initiatives. So then what happened? There's a lot of limitation on banks. Rely on banks is becoming very difficult as source of financing. Well, of course, in addition to this difficulty because of the capital, naturally banks also rely very much on majority short-term deposits. There will be difficulties, to fulfill long-term financing needs, by, very limited long-term deposits. That's why then there is kind of the mismatch as far as the banking concerned in doing lending.
Yeah.
That's why then this is very difficult. That's why in some emerging economies, when the need for long-term financing is quite significant, for instance, to finance the development of the infrastructure, for example, they need a lot of long-term financing source of finance. And then emerging market now busy, how to develop the economy, building toll roads, airports, and things like that. Relying on banks is becoming very difficult because of the capital constraint and things like that. That's why then it is quite significant shifting from banking-based lending to the market-based financing. I think it's quite significant evidence. We can see from the emerging market statistic, actually, the ratio of credit to the total financing is dropped and declined along the years, for the last 10 years. There's quite significant evidence that there is sense of shifting from the bank-based financing to the market-based financing activity. So this is very clear. There are two important problems with this. The first one is how to manage this transition from bank-based to the market-based financing. How we be able to manage the transition, and then the second question is basically related. Banks in emerging market is quite significant presence in terms of networking. Very extensive networking banks in most of the emerging market. I think shifting totally from banks to the market-based financing is almost impossible. That's why then it is also important to find out how to strike the balance between the existing bank-based lending and the future market-based lending. So there's two important questions, seems to me. The first one, how to manage in more general way from moving from this type of financing, and the second question is basically
how to transition. How
we be able to strike the balance.
Sure.
This is very important.
Sure.
Well, I guess there is no easy answers to these two questions, but of course. the prerequisite for this is basically we have to continue to develop our own capital market as source of financing. In emerging market, I think, well, we still lacking of the market infrastructure, lacking on education and financial literacy, lacking on, let's say, the deepness of the variety of products, and also the lacking in terms of the pool of the local investors. You know, I mean, that's really basically similar problem in the emerging market.
Sure.
That's why then it seems to me we have to continue to this direction. You know, introducing good corporate governance principles, not only for the public listed companies, but also, you know, to how we be able to handle the market with all the market integrity. You know, that's really very important. So it seems to me we have to continue the deepening to deepen our own market. You know. Supply and demand side, you know.
Sure.
Yes, supply meaning that we have to, well, educate the potential mid-sized firm in the country, you know, to go being public, infrastructure development, enforcement and things like that, introduction of technology. On the demand side, I think education and financial literacy is very much perhaps still the major issues in most of the emerging market. That's why then I do believe that, and also agree with these current global initiatives. You know, when our leaders talking about the financial inclusion, financial literacy, then how to develop more inclusive finance for the economy as a whole, which it seems to me it is parallel with the objective to educate people, not only the consumer at large, but also the potential companies to be listed to our capital market. So this is very important. Well, again, there is no short answer in this, and then I do believe that it is very important to bring this into the people, and then people understand what really how the capital market you know, works and things like that. You know, we conduct surveys, for example, on the literacy level as far as the capital market concerned. I do believe it is not only in Indonesia, but also in most emerging markets.
Right.
The literacy on the capital market is still very low.
Yes.
That's why then it is very important how we be able to sift, you know, with these particular situations. I think there is something to do, you know.
Sure.
And then the last point that I would like to make is basically emerging market is lacking on capacity to, you know, not only on the infrastructure, but also on the, you know, policies, people and things like that, you know. Because shifting from banks to market-based, you will be exposed with different type of risk. As far as the financial stability concerned, you know, crisis 2008, perhaps very much banks create some problems, but then the deep and the weight of the capital market also will expose the emerging market with different set of, you know, type of risk. You know, that's really very important. I think there is a very important question then. Shifting is very important. But how then emerging market be able to manage the risk because of this shifting? It is also very important.
Sure.
Because emerging market will also expose with the new kind of risk.
Sure.
Banking risk, well, they got already familiar, but capital market risk and the deep of the capital market risk will creating another different type of risk, which is then the policy maker in emerging markets should be aware of this. In particular, when the normal downturn of the economy will create different things if you still rely on banks, and then if you later rely on market financing. they have two different directions, but actually they are vulnerabilities. They are well exposed with some vulnerabilities. That's really a challenge for the decision maker in the emerging market. That's, I think, it's my point. Thank you.
Thank you. Can I request Mr. Tafari?
So let me start off by thanking the organizers for hosting this event. It's a pleasure to be here, and it's an honor to have been invited. My name is Ethiopia Safara. I'm Vice President for Corporate Risk and Sustainability and the General Counsel at the IFC, and prior to that I spent many years as a regulator in the U.S. By way of introduction, although I suspect it's probably not very necessary, the IFC is a member of the World Bank Group, and our mandate is to contribute to the economic growth in emerging market economies through the promotion of productive private investment. And our work on corporate governance is a big component of how we go about fulfilling our mandate. In my brief opening remarks, I'd like to bring IFC's experience across emerging markets to illustrate the connection between good corporate governance and financing the private sector. Regardless of the size of a company or the overall conditions of the markets we work in, we have consistently seen that good corporate governance attracts capital, good corporate governance lowers the cost of capital, and good corporate governance is the foundation of investor trust. And these are not theoretical concepts. We know that the cost of capital for companies listed in New York and London is far cheaper than the cost of capital for companies listed in emerging markets. And so what drives this difference? It is the investor perception about the quality of governance in a given market and in a given company. And a perception of weaker governance translates into a perception of higher risk and a higher premium on capital. And adherence to standards on transparency, disclosure, regulation, and enforcement goes a long way in building investor trust and confidence. And the OECD is obviously a leader in setting global standards of corporate governance. OECD standards, however, assume a number of conditions that are not always present in many challenging markets where the IFC works. And to bridge the gap, we work with companies, large, small, corporate, family-owned, to adapt high-level principles of corporate governance to their particular operating environments and where local standards lag behind global best practice. And so we develop tailored and practical solutions that allow our clients to meet internationally accepted standards and norms in a way that enhances their operating performance and growth and improves access to capital and lowers the cost of capital. So to illustrate the importance and the impact of this work, let me give an example of our experience in Brazil, and I think you may have heard something about this earlier today. We developed a tiering system for companies listed on Brazil's Bovespa stock exchange that corresponds to different levels of rigor or adherence to corporate governance standards. The companies in the first tier were meeting basic national legislation and regulation requirements. The second tier was composed of companies that voluntarily complied with heightened levels of corporate governance around disclosure, better accounting and auditing requirements, adhering to IFRS and IFAX audit standards, more rigorous board composition, and requirements of that like. And those companies formed what was then called what is called the Novo Mercado, or the new market. It's been over 10 years since the Novo Mercado was introduced, and results show that companies in the heightened tiers achieve higher stock values as early as listing. For example, there's a Brazilian utility company called CFPL Energia, and it reports that implementing a corporate governance improvement plan prior to listing resulted in a 65% increase in its share price. And we've used this model in various countries, including Azerbaijan, Cambodia, and the Philippines. Another example of our work is something we call SME Venture Fund Program that we established a few years ago. And through this program, the IFC provides funding and capacity building to support venture capital funds that invest in SMEs. We work to improve the corporate governance both at the fund level as well as the SME investee level. At the fund level, we developed an approach and practical tools to help fund managers assess the governance of the fund leadership and the governing structures. At the investee level, we've developed approaches to assess the quality of the company's governance and develop an improvement program. And improvements at the individual SME companies contribute to strengthening the overall quality of the fund portfolio, leading to greater investor interest and competition. And one of the SME venture success stories is a logistics company in Liberia called GLS Liberia. The firm was launched in 2011 with funding and technical support from IFC's SME Venture Fund for West Africa. Today, GLS has grown to become the leading logistics company in Liberia, employing 37 full-time staff. And having improved its corporate governance as part of the fund's technical assistance program, the company now competes on par with foreign firms, winning the last 5 competitive tenders in Liberia, and it plans to expand further to meet the vast needs for logistics in the country. Finally, an important component of our work at the IFC is sharing our experience with markets and like-minded counterparts. And so the IFC has initiated and led the development of something called the Corporate Governance Framework. It's a coalition of 30 development finance institutions like the IFC, including EBRD, ADB, FMO, that are committed to using the same methodology to assess investee companies in terms of their corporate governance. And in essence, our view is that improvement in governance is a public good and helps us all, and that's that's the thinking behind that initiative. Why don't I stop there and we'll chat a bit.
Thank you, Mr. Tafara. You know, just sort of taking a quick summary across several of the comments that all of you made, I think 2 themes certainly come out. One, that large-scale funding requirements, for example, infrastructure projects in many of our economies, there is still no royal highway by which that kind of a funding or financing can happen month on month, year on year, if those requirements are large in many of our markets. So I just want to hear from Mr. Tafara, looking at several of the other market economies, since you see a broad spectrum of these. One of the comments, or one of the insights I have gained from these comments is that we need to deepen the market before we move out of bank-based financing into market-based financing. Therefore, if infra projects have to really be largely funded, let's say, from markets, is it an experience that you see that we need large institutional investor players there? Is that a precondition? Or is there some other precondition that you see in successful markets that are able to fund long-term, say, infra capital needs, whether debt or equity? Is there any interesting example from the different markets that you all have viewed?
I don't think there's a shortage of funds, right? I think there's vast. In fact, if you know, just last year, I think the OECD did a study of the assets under management. They're to the tune of 92 trillion, right, worldwide, and they're constantly looking for opportunities. So there is money available to invest in a range of projects. The question is, what needs to be done to de-risk that money flow? And in many instances, they have fears about investing in certain markets by virtue of a certain lack of transparency, by virtue of concerns about the governance and the structures that they would be investing in. So really the challenge is actually creating the environment, de-risking the environment so those private capital flows will go to where they're most needed. So I think the work really is around what companies and market actors are doing and what governments are doing. Yeah, as you know, Chitra, we were recently in Rwanda having a discussion with the government and the market there, and making clear to the market participants there's a lot that you can do to actually build confidence in the marketplace, build confidence in people allocating capital to companies and projects here by virtue of what you do as individual actors in terms of transparency, in terms of what auditing firms and accounting firms are doing, in terms of what credit rating agencies are doing. And then there's a lot the government can do to impose certain requirements that actually will create the environment that builds the trust necessary for that capital to flow. And it's in different stages in different markets, right? So there are certain markets. I mean, I think what they did at the Novo Mercado is extremely interesting, right? This was not a regulatory initiative. This was something that was done at the market level, that they took upon themselves to actually create an environment in which people were willing to adhere to higher standards. And what happened was
capital was attracted to that, and the cost of the capital for those firms went down.
Sure. If I can ask, both of you to comment on one of the aspects again, which was linked to moving to market-based financing, which is depth of the market, in consideration. For example, if you look at the market in Turkey, is it your assessment that the participation of institutional investors in the local market is adequate to take the kind of movement from bank-based financing into market-based financing? Is it largely the local local institutions that take that kind of risk? How do you see this play out, and how do you see this as a key ingredient in being able to take long-term capital from the local markets? Yeah.
If I may, yes. I will differ here from Mr. Chairman. Basel III is basically a children's storybook for banks. It won't constrain them, make them even freer, more free. Basel III. In fact, when you think about it deep down, the more you regulate banks to make them safer, the bigger you make them. That's for sure. Because more strongly regulated banking is psychologically and practically a safer deposit taker than anything else. And Basel III, in my opinion, will result in less market-based financing on more bank financing. That may sound strange, but look at liquidity is everywhere. And banks can give long-term credit to infrastructure projects. This would be a funny sentence 10 years ago or 15 years ago. That's how it works out. So I don't think we can do it through regulation or rules. It's basically issues like corporate governance, environmental, social governance, all those things we have to worry about. That's how the market should go in its own flow. You can't do that. The more regulation you put in banking, the unhappier we will become on this. It is myself. Mm-hmm. Regulation will not make banks smaller, makes them bigger. Mm-hmm. That's the way it is.
I agree with Professor Akiray. It is fascinating to me that these large infrastructure projects in Turkey obtain most of their funding from Europe, but intermediated through Turkish banks. That's a puzzle to me. There are some answers. Why isn't that it's the foreign investors lending directly to these infrastructure projects directly? There are some explanations, but it all comes down to de-risking. If these projects, the environment, had sufficient protections for foreign investors, they would be investing directly and not add another layer of Turkish financial intermediation. Mm-hmm. So I think that's, in fact, an important source of systemic risk that affects stability of a country like Turkey. I want to, if I may, on your opening remarks, you mentioned investor participation, the importance of that for depth of financial markets. There's a private pension system in Turkey, started in 2003, hasn't been very successful, but just last, I believe, in 2012, underwent a major reform. It's also to address the low savings rate of the country, to incentivize households to save more. The government contributes up to 25% of the individual contributions to defined contribution pension plans. It's limited by the 25% of minimum wage. So it's not a huge subsidy, but 25% is very attractive. But I fear that subsidy is not being very effective. And the reason is, again, related to institutional asset management. I have some friends in the audience, so forgive me, but by international standards, the cost of managing those funds, high management fees, roughly in the tune of 2%, is an order of magnitude greater than the international benchmark of 10, 20 basis points for passive funds. So what that means is the 25% government subsidy comes in, but the government contribution fully is vesting in 10 years. So you have to pay this extra cost of management fees for 10 years. Let's say that extra fee is 1.5%. Over 10 years, that's 15%. So the 25% subsidy given by the government is out the door with the 15% management fees. So, you know, I hope there will be lower fees in the future so that the subsidy is more effective in encouraging savings by households. I would also say, I mean, this is just an idea, thinking out loud, if more equity financing is desirable, which I believe is the case for Turkey, to make it to make the system more resilient, more stable, less fragile, equity financing needs to be incentivized. Perhaps the government subsidy for equity investments participation could be greater than the government subsidy for debt investments. Tools like that could be used. And one other thing, if I may, if I have time, coming back to SMEs, it's part of the panel title. The corporate governance regulations that just went into effect in 2014, they've been very smart. So I want to thank the Capital Markets Board for being smart about scaling and having proportionality. So there are 3 tiers, and lower, you know, for small companies, for SMEs, less of the mandatory provisions apply. So that I believe is smart regulation and being flexible to bring in those companies into the market and not make it so costly. That I think is a very important design element. And one last thing related to SMEs, Borsa Istanbul again just launched a market in November 2014. It's called the private market. It's for pre-IPO firms. It has 2 segments, one for rising companies, the other one for startups. So these companies must be plan to have an IPO in 3-4 years and have some minimum asset sales of 5 million Turkish liras, about $2 million. And the idea is you want to have an ecosystem where these companies come, they can have access to financing before IPO, or also you could have liquidity of company partners and early investors to go in and out, and at the same time provide legal and financial advisory services on this platform. It currently has about 100+ members, 62 investors, 29 startups, 18 rising companies. So all these reforms and regulations, new markets I've mentioned, they're all recent, and we don't quite know if they will be successful or not, but I'm glad to see these experiments take place.
Yes, Mr. Tapar.
I just wanted to make up one point. I don't know if this is consistent with what Vedat is saying, but from an emerging market standpoint, I think banks are regulated to be conservative. After all, they've got public deposits on hand, backstopped by the government. So taking major risk is not something that is encouraged by the regulation of banks. It's just runs contrary to the nature of the business. And that's fine. If you look at it from the standpoint of emerging markets, I think emerging markets, and let's agree that I think the Basel Capital Accord is designed to make it even more conservative in terms of its activity. And I think banks view emerging markets as being relatively risky, and I think they're being regulated as risky places to place your money. That makes it all the more important for there to be an alternative that's created in these emerging markets for financing. If banks are pulling back and banks are disinclined to take major risk, you need alternative financing for the companies in these places, and it is the capital market. And I don't know if I completely agree with the colleague to my right. I don't know that it's transitioning from one to the other. I think you did say you're going to end up needing both. I don't think you're going to be able to supplant bank financing, but it has a role to play that is different at times from
market financing. And indeed, having both leads to greater resilience in the system. I think systems that rely too much on one form of financing end up finding that they're not resilient when there's a shock to that particular part of the system.
Quite true. And in fact, just to sort of take that one step ahead, you know, when we talk about what is policy nudging, in what direction is it nudging, I'm curious to sort of hear from any of the panelists whether there is a conscious push to move from, for example, the same credit which goes to a bank, and if it is accessing the market, is there an incentive to do it from the market? And I don't mean a financial incentive at this. Just to give you an example, in our markets, the mark-to-market rules make it much more expensive for a bank or any other institution to hold a bond which is a credit rather than to hold it as a loan. So this is not an incentive, it's actually a disincentive. So, you know, what puzzles me is that if there has to be a policy nudge, then one has to think about how to make credit in the form of securities or from the market more attractive for a borrower, which is really what I mean when I want to understand whether any of the markets have these kind of conscious incentives or pushes towards, you know, raising credit from the market rather than going back to the banking system. Mr. Haddad, do you have?
Well, thank you very much. There is a structural problem, seems to me. In most of the emerging market at the moment, the role of or the ownership of the foreign investors is quite significant. Let's say Indonesia, 64% of the equity market owned by the foreign investors, institutional investors. And I was told Turkey also is similar size, around 64% owned by the foreign investors, you know. And then what happened in this current particular situation when the world is becoming more globalized, you know, we are very vulnerable with flows, capital flows. You know, recently, I think for the last 2 months, emerging market hit quite significantly because of shifting of capital and the stronger US dollars, for example, you know. And then this creating not really quite so conducive environment for, let's say, because those who are keen to go to the market base then face the realities that the fluctuation of the markets is quite significant in emerging market. And they're creating another problem for, let's say, those who are really keen to move from the banks to the capital market. This is also the issues, you know. That's why then it seems to me there is some problem on our emerging market, capital market, you know, because it's not
deep enough.
It's not deep, you know. There is some issue. That's why then it seems to me we have to do, you know, this work. Our homework is basically how we have to deepen, while we still rely on the banking financing. Yeah.
Sure. On that note, yes.
I mean, it's not like the bank's money is here, market's money is here. I mean, if a company issues bonds or equity, that money goes into a bank again. I mean, that arithmetic should not be missed. It's a matter of the difference between the contractual and financial risks implied by a bank contract or a market-based issue. I mean, that makes the difference of the level of financial risk, and that's what we are talking about. I think it's beyond what we can do today here.
Couple words to add to this very item. You see, bond market in Russia emerged in the year 1999 when I managed, it was my job in those days, to equalize the tax consequences for bond issuers as the credit borrowers. You see, it become equivalent to the corporations, either borrow credits or issue bonds with respect to the taxation of their expenditures. And you see, nowadays, I do believe that we could fill our bond market with the individual savings when we'll manage to equalize the taxation for individuals with respect to deposits and bond interests, since nowadays there is no use to invest anywhere else except deposits, since deposits are guaranteed by state to some extent. And you see, frankly speaking, no taxation of the deposit income. And you see, there is no use for individual to buy anything else.
Different instruments.
The arithmetics doesn't work.
Sure. So, gentlemen, with your permission, maybe we will open it up to the House, and if any of you have questions, if you can identify yourself and also mention the person to whom you are directing the question. Yes, sir. I think they're getting you a mic.
Thank you.
Madam Chair, thank you for volunteering to offer questions to the floor. You said you were the last session, and do I take it that we can ask questions which also implicate the other sessions, or are you just prepared to field your own?
What we can do is we can, of course, ask them to take the questions and they will respond to you offline. I guess we can answer the questions that you have for this panel.
Okay, my question to the group as a whole refers to the price mechanism which the markets develop. In the developed economies, because of frequent quarterly disclosures of results, there is a general premium that is attributable to companies that are better governed than others. This mechanism, however, does not exist in the emerging economies, for the simple reason that there are other variants which come into play for the market price, and so you never really know what is the premium that is being attributed to the better governed companies. So in your experience or the experience of any of the panelists, is there a methodology, or is there some mechanism which could be developed for emerging economies, for the capital markets, so that access to capital would begin to flow freer than what it has been doing up to now?
Thank you very much for asking that question, because this was one of the insights we would have discussed. And just to sort of add on to Mr. Tafara's experience, what he shared in his opening remarks, I think one of the struggles we have had, for example, even in the Indian or other emerging markets which share the same note, intuitively speaking, there is a sense of, you know, the better governed companies and the other governed companies. But it's really work in progress to see if we can put a kind of a premium or a number there. The Novo Mercado experience, which Mr. Tafara talked about, of course, you know, stands out as an example in that context. But I must say that in our market, for example, there are some efforts around governance ratings that have come around. And while we can certainly argue about how accurate this is or how scientific this is, but I think the work has started in the direction to start to put out some gradations in the governance of issuers which are on the market. Any of you gentlemen would like to add to this?
Sure. So I think your question is excellent. And for policymakers, before they introduce new rules, they struggle with that. Are they benefiting society or harming society? And so it's very difficult for them. But then for us scholars, we can actually use the regulation regulations that are passed as quasi-experiments, because some companies are already in compliance. So think of it as a clinical trial. You're now treating some new firms with new rules, and then you can trace the effect of these new regulations on those treated firms and compare them to the control firms that were already in compliance. So scholars do research of this kind, and I'm happy to report just last week the Corporate Governance Association of Turkey decided to support an impact study that will assess the new corporate governance regulations effective in 2014 in Turkey. So we need a couple of years to assess the impact. I would even just maybe mention the kind of details scholars can use. As I mentioned, there's a tier system in Turkey. So these tiers are hard numbers, 3 billion Turkish liras, 1 billion Turkish liras. So just around these thresholds, you can argue companies are more or less the same. But just because the company by accident falls below, by random, almost random luck, just falls below 1 billion and above 1 billion, then you can compare these two firms and see if the effect of that tiering system on the performance of affected firms.
Stefan? Yeah.
And I think if you can, the two-tier system is actually an excellent way of figuring out what the premium for good corporate governance is, right? In essence, all the other factors will be the same for the companies. The only difference would be the corporate governance requirements that apply at one tier, which will be the basic, if you will, and on the second tier, which will be heightened. And that will give you a measure. The cost of their capital, the difference in the cost of their capital will give you a measure of what the premium is for the good corporate governance, I would think. Now, I don't know if that's possible to replicate everywhere, right? But if you can, it seems pretty effective in getting to what you're trying to get to.
Sure. Do we have any?
I don't think you can empirically test the impact of corporate governance on price performance. I mean, that's nonsense, because corporate governance should result in better price performance. What you are testing is the regulation of corporate governance. And the best test in 100% R-squared is that if you plug in new rules, if companies are running away from you, it's bad rules. I mean, you don't need time series study for that, I think. Sorry, you cannot, it's good, it has to be better performance, period.
Sure. Any other questions? I think we could do maybe two more.
Just about corporate governance, yeah, and how measure the good corporate governance. You see, 3 years ago, we launched with OECD, 3-year OECD Russia Corporate Governance Roundtable. The most significant result of this roundtable was the adoption of new Russian corporate governance code, which has been already highly estimated by a recent joint study, Balancing Rules and Flexibility, made by ACCA KPMG Singapore, a study of corporate government requirements across 25 markets, due to which Russia was estimated as the 7th, along with Hong Kong, proven the effectiveness of our joint work with the OECD team. Now I would like to take the opportunity to congratulate India with a very high 4th position in this rating or ranking, just after the UK, the United Kingdom, and the United States, and Singapore. And now a quotation. Mats, could I ask you to stay with us, Mats? Yeah. Quotation, implementation is key. Okay. And the author and the classic is with us. It's Mats Isaksson, and who was the responsible person on OECD side for this roundtable activities. And you see, just now we are prolonging roundtable activities for another 3 years with the main goal to comply with this Mats testament. Sure. And surely the key persons to test whether corporate governance is good or is relevant, or what should be done in corporate governance, would be investors along with regulators, not the regulators only.
Sure, thank you. Any other questions from the floor?
Hello.
Yep.
So, Madam Chair, my question is to you. I would like to thank all of the panelists, but I would like to ask you, many studies, scholarly papers show that board diversity is good for financial performance, and female directors are really effective. However, we are seeing so few female directors in the boardrooms. We are seeing so few panelists who are female, so the question is fair, I think. So why do you think that's the case? Many studies do show that there is a positive impact on the financial value when there is board diversity, but we are seeing so few diverse boards, especially few female directors. What is your view on this? Thank you.
Well, no, I will just preface it by saying perhaps I might have a biased view, and we will also let the other panelists have their say on this. But as we speak, I think there is a more conscious push from a policy perspective to ensure the gender diversity. In fact, in India, we have this corporate governance requirement becoming mandatory from the 1st of this year, and you can look at it as a gain or a loss, depends which way you look at it, but about 80% plus of the companies listed on the exchange, for example, are compliant. So they do have a woman director on board. And I think making this mandatory certainly gave the push to bring that kind of a diversity. I'm sure the next level of questions will be, are the women directors independent? Are they representative of shareholders, et cetera, et cetera? But that's why I said you can start by looking at it as a positive, which is to say that we're certainly, accelerating the pace of this board diversity discussion in many markets as I see it. Any of you gentlemen?
I would simply say that I think you're right. The studies are quite clear. I think reality is catching up to those studies, probably a little more slowly than one would want. We, as an investor in a number of companies, by virtue of being convinced by the studies, are committed. We get to put nominees on boards, and it is our objective to get to at least 50% women nominees on these boards because we're convinced it's better for our investments.
Right, absolutely. So if there are no more questions, oh, there's one more, please.
It's not a question, it's just a point following my colleague's point on gender diversity. Certainly this is not the case, it's not obvious in the current revision of the principles of corporate governance of the OECD. There's nothing on board composition or gender diversity, and I do hope that it will be included in the IFC revision of corporate governance principle, that gender diversity is not going to be omitted.
Thank you.
They didn't want to hear that.
Well, we will convey it to Mans.
I should mention the new Turkish corporate governance regulations do have a 25% target. It's not mandatory, but it is mentioned, so regulators are pointing out that boards should think in that direction. And there are campaigns, I believe the Corporate Governance Association will be involved in, it's called 23 by 23, hoping to have 23% female directors on boards by the centennial of the Republic in 2023.
Interesting. Yes, if that could be the last question, please.
My question is maybe I cannot read your name. Within the codifying the responsibility of the board of directors, are we going for those corporate governance? Because somewhere in the Indian Act, just recently introduced in 2013, where the director's role, responsibility has been codified. So we have a schedule which talks about what directors should be doing, do and don'ts for the directors. Now, is it a good idea? Is it because somewhere maybe you are writing something which is good, maybe not good for the, so you cannot have a par, with all the companies. So my question is to you, sir.
Well, I certainly think it is useful and important for there to be clarity around the duties and responsibilities of board directors, and if that's what the legislation is intended to do, I think it has enormous utility. And I think in particular, it's good to articulate what the relationship is to be between shareholders, board directors, and management, because that's usually where governance breaks down. I think a clear articulation of duties and responsibilities is a good thing, and I don't know whether that's what the legislation does, but if that's what it's doing, I see no harm in it. In fact, I think it's the wise course to follow.
This is in India. We did it for the first time, where there is a do and don'ts for the directors and independent directors, and there is something called independent directors will do the appraisal of the whole-time directors, and the whole-time directors will do the appraisals of the independent directors.
I think that's actually a good subject for the next panel discussion.
Yeah, probably.
And we should probably take that offline, with your permission. So thank you very much for all those questions and making it interactive. Just to wrap up our table for today, I think a couple of interesting things that really came out was the volatility in markets, in emerging markets, that becomes a source of being unable to attract long-term capital money in those markets. Second, an ability to fund long-term projects, sustainable capital for long-term projects. And, as I was thinking about this forum, one of the thoughts that, I want to sort of leave with the panel is that there's a lot of, the BRICS summit, for example, this time talked about how to, make some of this available to the BRIC group of countries. And my thinking is that perhaps it's time for us to think about going beyond BRICS to the G20 countries, which is the kind of forum which all of us represent here, and the kind of derivatives that were created out of the BRICS summit. If there is a way in which we can put together a long-term fund, which helps the participating countries to manage the short-term market volatility, currency volatility, and the countries which are therefore participating in it borrow in the same currency. So it's a multi-currency kind of a fund. I think that will be able to create some kind of impetus for market-based financing amongst us as a group. And I think Africa has done a very good work on those lines, the South African Development Bank from the African Regional Center. Maybe we can draw cues from some of those, and if that's possible, I think me as coming from India would be very happy to sort of put my cards on the table and work this with the rest of the countries here. The short point is, I think we should look beyond BRICS to the larger G20 charter, and we must think about how we can create some instrumentalities as funds which can help overcome not just the funding for the projects, but also the currency volatility that our markets face. So thank you very much. It was great to have this discussion with all of you.
We would also like to thank our panelists. And we've come slowly to the end. We've got our closing and concluding speeches. I hereby invite Mr. Tayfun Beyazit, Advisory Board Member of the Corporate Governance Association of Turkey, to the stage, please, to deliver his closing remarks.
Thank you very much. Distinguished guests, ladies and gentlemen, it's my pleasure to address you on behalf of Corporate Governance Association at the closing of this event. I would like to thank OECD, thank you, Capital Markets Board of Turkey and Corporate Governance Association and Boğaziçi University for this very successful organization. Today, we had a chance to discuss vital topics as having finance serving real economy, value creation with corporate governance, and institutionalization of growth, which is very crucial for economies like Turkey, where SMEs are the main engine for growth and employment. As discussed today, first released in May 1999 and revised in 2004, the OECD principles are one of the key standards for international financial stability. Now these principles are revised for new markets and developments. Let me draw your attention to some crucial points of the new principles, which I personally find quite important. Risk management policies and processes, which were not existent before, are quite widely covered. A risk committee and a risk president are considered as best practice. Wage policy disclosure now includes disclosure of the wages itself. It is suggested to form a risk and wages committee, taking the size of the company into account. The principle requiring independent board members constituting the majority is changed to a significant part. I think this is especially relevant for emerging market economies where shareholding is concentrated and predominantly family-owned. Corporate investors and stock markets are added to current headings. It is stated that the regulator's instructive works may cause to conflict of interest. Stock markets are rightfully given responsibility to embody various executions. New principles indicate that economies of scale should be taken into consideration. In addition to shareholder structure, geographical conditions, life cycle assessment of company should not be overseen. Gender diversity in board and top management is highly supported, even though, as it was in the previous comment, maybe there's not enough done yet in this respect. Malus and clawback regulations are considered as best practice. In any case, corruption and dishonest to regulations which cause loss to company will be compensated from managers' remuneration. Boards should practice performance rating of their own regularly and test if their abilities match companies' needs or not. If employees are represented in the board, it should be effective and must have position and responsibilities as the company must guarantee other board members. And related party transactions should be approved and conducted in a manner that ensures proper management of conflict of interest and protects the interest of the company and its shareholders. And specialized court procedures can also be practical instruments to obtain timely injunctions and ultimately facilitate rapid settlement of disputes. I believe that this principle may have a wide area of practice, thinking the advantage of effective dispute resolution. The board has a key role in identifying potential members for defining general or individual profile of board members that the company may need at any given time, considering with the appropriate knowledge, competencies, and expertise to complement the existing skills of the board. In this way, skills of board member candidates will be important than just their names. I think all these new principles present a number of means and ways for legislators and private sector to adopt the best governance culture in their institutions. On that note, I would like to thank you again to all the contributors and participants to this important event for making this day a very fruitful one. Thank you very much.
Thank you, Mr. Vice. And I would like to invite right now Mr. Kenji Okamura, Vice Chair of the OECD Corporate Governance Committee, Deputy Commissioner for International Affairs of the FSA of Japan, for his concluding remarks, sir. The floor is yours.
Thank you very much for kind introduction. As introduced, I'm Kenji Okamura from Japan's Financial Services Agency. And it's a great honor for me to have this opportunity to say a few words, particularly as very last speaker after long hours of listening. I think I have two missions now. One is to provide some wrap-up of the entire meeting, and the other is to finish short. So this is not always easy, and particularly for this kind of substance-rich meeting. But I will try my best to finish short. First of all, as a vice chair of the Corporate Governance Committee of the OECD, let me express my deepest gratitude to you all for participating in this event and for your cooperation in making this event a great success. Let us recall today's meeting. After the warm welcome speech by Chairman Eltashu, we started with the strong message from Secretary General Mr. Angel Gurria, represented by Mr. Mats Isaacson. You may recall that we saw Mr. Gurria's figure through Mats. And his commitment was very clear. Commitment to an upgraded cooperation between the OECD and the G20 towards the common goal of corporate governance for growth. And then Marcello's keynote speech clearly showed the background, objectives, features, and spirits of the review of the principles. In particular, I would stress the process of this review has been very inclusive, involving active participation from both in and outside the OECD, notably non-OECD G20 countries. In this way, the new principles are a joint product of the G20 and the OECD from the beginning. Based on the solid basis placed by Marcello's keynote, our discussion highlighted three main issues today. In the first session, you may recall, we discussed how the new principles are designed to guide household savings via well-functioning capital markets, leading to productive real sector investment. And paying particular attention to scaling and proportionality issues on the scope of applicability of the principles in implementation. And in the second session, we discussed on growth companies and SMEs. Specifically, we explored possible ways how improved corporate governance facilitates access to capital, value creation, and job creation for all companies, including smaller and unlisted companies. Based on today's discussion, we continue our work to come up with a report on the use of the new principles for SMEs, as called on by G20 finance ministers. And in the third session, we discussed how to tackle the common challenges in many emerging markets, namely mismatch between fast-growing corporate sector and still developing, in some sense, the capital markets. Particularly, in the context of shift from bank-based finance to market-based financing. And tentative conclusion I received from the current session just finished right now, improved corporate governance would be expected to enhance effective capital market development, reduce cost of capital, support efficient financial intermediation in emerging markets. And from today's discussion, I think our message has been clearly defined and conveyed to the rest of the world. We all share the spirits and features of the current review of the OECD principles. That is, corporate governance to support economic efficiency, sustainable growth, and financial stability, taking into account recent developments in the corporate sector and capital markets. The way forward after the completion, or I would say successful completion of this event, we will be entering into the next phase. That is a dissemination process of the principles. As clearly shown, the principles are designed to provide robust but flexible reference for policymakers to use. In this sense, as discussed today, Japan has formulated its corporate governance code along with the new OECD principles. I would invite all relevant jurisdictions to join in this kind of initiative of using the principles for national policy making, wishing that the new principles will become a useful guide to improve corporate governance as effective policy measures towards sustainable growth. To conclude, I would like to reiterate my sincere appreciation for all of you and all of your efforts to make this event a very, very fruitful discussion and successful one. Finally, let me express special thanks again to Capital Market Board of Turkey, Turkish Corporate Governance Association, and Boğaziçi University for hosting. Thank you so much for your kind attention. Thank you.
Thank you, Mr. Okamura. I would like to now invite Mr. Mithat Rende, Ambassador, Permanent Representative of Turkey to the OECD, Chair of the OECD Executive Committee, to the stage for his closing remarks, please. No? Oh, I'm sorry. The gentleman is not here right now, so I guess that's the end of the day. Ladies and gentlemen, I hope you had a good and pleasurable event. The International Forum on G20 OECD Corporate Governance Forum has now officially been closed.